All right, everyone, welcome. Today, we're going to do something really interesting. We're going to build the financial story of a brand new company right from the very beginning, one transaction at a time. Our goal here isn't just to learn the rules of accounting. It's to understand how accounting works as the essential playbook for making smart, strategic business decisions. We're going to see how every single choice a manager makes gets translated into this universal language of business.
So let me start with a question for you. Think about any manager, any investor, any entrepreneur out there. They all face the same challenges, right? They've got to figure out how well they're doing, where to put their money, and how to convince other people to believe in their vision. To do any of that, they need a common ground, a system that everyone understands and trusts. So, what is that critical language that really holds all of modern business together?
You got it. It's accounting. But let's be really clear about something. We are not just talking about bookkeeping here. Bookkeeping is just the act of recording the data, writing down the numbers. Accounting, well, that's the art and science of analyzing and interpreting that data. It's the framework that lets us take a company's pulse, diagnose its health, judge how it's performed in the past, and make some really educated guesses about its future. For anyone in this room studying business, becoming fluent in this language isn't just a good idea, it's absolutely essential for becoming an effective leader.
So, here's our roadmap for today. We're going to follow the journey of a new company called SoftBite Inc., and we'll use their story to bring these ideas to life. We'll start with the single most important rule in all of accounting. Then we'll see how the company gets started, how it buys the tools it needs, and how it starts actually making money. And we'll wrap up by looking at how knowing all this helps you avoid some very common and very expensive mistakes.
Okay, let's dive in with the one fundamental rule that governs everything else we're going to talk about today, the accounting equation. Seriously, every financial report, every analysis, every big concept we'll ever study is just a more detailed version of this single core idea. It is the logical bedrock of this entire field. And here it is. Assets equals liabilities plus equity. Now, this isn't just a theory, it's a fact, it's a logical truth. Let's break it down. On the left side, you have assets. Think of assets as all the valuable stuff the company owns or controls that's going to help it make money in the future. We're talking about cash, equipment, buildings, you name it. Now, the right side of the equation tells us who paid for all that stuff. It answers the question, who has a claim to these assets? And those claims fall into two buckets. First, liabilities. This is what the company owes to outsiders, banks, suppliers, lenders. It's the creditor's claim. The second bucket is equity. This is what's left over for the owners. It's the owner's claim. And here's the key. A company can't just have an asset magically appear. Every single thing it owns had to be paid for by either borrowing money, a liability, or by the owners putting money in, equity. That's why this equation always has to be in balance. It's a perfect closed system.
All right, so we have this abstract theory. Let's make it real. We're going to apply this framework to our case study, SoftBite Inc., and watch how this equation works with their very first business transaction.
So here we go. Transaction number 1. The owners, Ray and Barbara, are taking their own money and investing it to get the company off the ground. Now, this is a crucial detail. They are giving that money to SoftBite Inc., which is now its own separate entity. This is a core idea in accounting we call the economic entity assumption. It just means the business's money is the business's money, and the owner's personal money is their personal money. You never mix the two. So let's see what this does to our equation.
Take a look at the effect here. Before this happened, the company was just an idea on paper, right? Zeros all the way across. Then, Ray and Barbara invest their 15,000 euros. So, the company's assets, specifically its cash, goes up by 15,000 euros. Now, to keep our equation balanced, the right side also has to go up by 15,000 euros. Where did that claim come from? Well, it came from the owners. So, the equity part of the equation goes up. We call this contributed capital. And look at that, 15,000 euros in assets on the left is perfectly balanced by 15,000 euros in equity on the right. The equation holds.
So what? What does this actually mean? Well, this is a huge deal. This isn't just moving money around. This is the moment the company becomes a real, legal, and economic entity separate from its owners. That separation is what protects the owner's personal assets if the business gets into trouble. It's fundamental. The company now has resources, actual cash, that it can use to start operating and making money. And the owners, they now have a formal claim, their equity, on the company's net assets.
Okay, so SoftBite has cash. That's great. But you can't really generate revenue just by having cash sitting in a bank account, right? You have to put that money to work. You need to turn that cash into productive tools, and that brings us to our next transaction, what we call an asset exchange. So what do? They take some of that cash and buy 7,000 euros worth of equipment. This is a classic business move. Management is basically making a bet. They're betting that this new equipment will help them generate way more than 7,000 euros in future profits, making it a good use of that cash.
Now, here's a question I get all the time, and it's a very common point of confusion. The company's cash balance just went down. So, does that mean the company is now poorer? Is it less valuable than it was a moment ago? It kind of feels like it should be, but let's see what the accounting equation tells us. It gives us a very clear answer.
And the answer is no, it's not poorer at all. Look closely at the assets column. Yes, the cash account went down by $7,000. But look what else happened. A brand new asset account, equipment, popped up, and it increased by $7,000. The total value of the assets is still exactly $15,000. All that happened was a change in the form of the assets. And notice, the right side of the equation, liabilities and equity, is completely untouched. This wasn't an expense. This was a strategic swap, trading one type of asset for another. The company isn't poorer, it's just better equipped to do business.
All right, the company is set up. They've got their starting capital, they've got their equipment. Now it's time for the fun part. It's time to actually start doing business. And this is where we get into the two most important activities of any company: generating revenue and incurring expenses.
And here it is, the moment every new business owner dreams of: the first sale. SoftBite did some work for a client, and they got paid 1,200 euros in cash. This is what it's all about. This is revenue. Formally, it's an inflow of assets from doing what your business is designed to do. This is the engine of the whole operation.
So let's trace the impact. The company's cash goes up by 1,200 euros, so total assets are now 16,200 euros. Now, to keep everything in balance, the right side has to go up too, and that increase goes straight into equity. Why? Well, think about it. The business just became more valuable because it earned a profit. And who does that new value belong to? The owners. The profit the company makes increases the owner's claim on the business.
Okay, on to the next real-world scenario. SoftBite needs supplies to keep serving its customers, but management might want to hold on to their cash for things like paying employees next week. So what can they do? They do what businesses do every single day. They buy the supplies on credit. They get what they need now and promise to pay for it later.
Now watch what happens to our equation. This is new. On the left side, assets go up by 1,600 euros because now they have all these new supplies. But they didn't pay cash for it. So to keep it balanced, the right side also has to go up by 1,600 euros. It doesn't go into equity this time. Instead, it creates a liability. This is called accounts payable, which is just a formal way of saying the company owes money to its supplier. So the equation balances again. Management has made a smart trade-off. They got the assets they need to keep working by taking on a short-term debt.
Of course, running a business isn't free. You've got to pay the rent, you have to pay your employees, you have to keep the lights on. These are the necessary costs of doing business, and we call them expenses. And this transaction shows a really key idea in accounting called the matching principle. You always want to record your expenses in the same time period that you record the revenues they helped you earn.
Now, pay very close attention to what happens here. The company's cash goes down by 1,700 euros. But, and this is the important part, unlike when we bought the equipment, we are not getting another asset in return. The value from the rent, the wages, it's been used up, it's consumed. So since assets went down, something on the right side has to go down to keep it balanced, and that something is equity. Expenses directly reduce the owner's claim on the company's assets.
So let's just boil this down, because it's a huge deal. Revenue is the good stuff. It's an inflow of assets from doing business, and it makes the owner's slice of the pie bigger. Expenses are the costs you have to pay to earn that revenue. They represent an outflow of assets, and they make the owner's slice of the pie smaller. The entire game of business management is to make sure that the revenue inflow is a whole lot bigger than the expense outflow. Okay, so we've walked through the mechanics. We see how all the pieces move and how the equation always stays in balance. But now we get to the most important part. How do we use this knowledge to make smart decisions? And just as critical, how do we use it to avoid some really common and really costly traps that people fall into?
Let's break these down because they are so important. First, and if you only remember one thing from today, remember this: cash is not the same thing as profit. You can have a company that's wildly profitable on paper, making tons of sales on credit, but if it doesn't collect the cash from its customers, it can go bankrupt. We see it all the time. On the flip side, you can have a company with a huge bank balance because it just took out a big loan, but it could be losing money every single day. You have to look at both. Second, you have to understand who gets paid first. Remember the right side of the equation? Liabilities and equity? Think of it as a line. The creditors, the banks, the suppliers, they are always first in line. If the company gets into trouble, they get paid first. The owners, you get what's left over, if anything. That's why taking on debt is so risky. And finally, you have to change how you think about expenses. It's so easy to just think, expenses are bad, let's cut them. That's a terrible way to manage a business. Smart managers see expenses as investments. You don't spend money on marketing, you invest in marketing to get future sales. The goal isn't just to cut costs, it's to make sure every dollar you spend is generating an even bigger return.
So I'm going to end by turning the tables and putting you in the driver's seat. We've just built the financial story of SoftBite's first 5 transactions. You've seen everything. You're the consultant they just hired. What is the #1 piece of advice you would give to Ray and Barbara right now? Should they watch their spending? Should they borrow money to grow faster? Should they focus on getting more customers? Your ability to look at these numbers, to understand their story, and to give a smart, reasoned answer, that is the bridge from just knowing accounting to practicing real strategic management. And making that leap is exactly why you're in this program.